something, don't worry. You'll be able to review it again in the recording. Also, if you've missed any of the previous webinars in the series, those recordings are available on your Wellworks portal. If you'd like to ask a question during the webinar, please use the Q&A button. It should be at the bottom of your screen. We've already received a number of questions in advance of today's webinar, and Eric will try to address as many as he can, as well as the questions that we get asked during the webinar today, but we will try to keep today's session to just an hour. So with all of that out of the way, let me introduce today's speaker. Eric Strid is the co-founder of Concentus Wealth Advisors. Based outside Philadelphia, Concentus is an independent SEC-registered investment advisory firm with over $500 million under management. Eric is a graduate of Amherst College and has been in the financial advice business for over 25 years. He's a certified financial planner, chartered financial consultant, and is the author of 3 books on investing. He's been featured or quoted in a number of different publications and media outlets, and he's appeared on CNBC's Worldwide Exchange, CNN8's Money Matters Today, Fox News's America's News HQ, among others. Most recently, Eric was named to the Forbes 2021 Best In-State Wealth Advisors list for Pennsylvania. So, that being said, welcome, Eric.
Can you hear me?
Yep.
Hopefully I'm broadcasting here. Perfect. We have our technology in place. Good afternoon, everybody, and welcome to the webinar. My name is Eric Strid. I'm the founder of Concentus Wealth Advisors, and we specialize in helping families to build a financial strategy to grow your wealth so that you can achieve the things that are most important in life. So before we get started, as I do every time, I want to let you know how excited I am that you're taking the time to attend today. I've learned that almost every American wants to achieve financial success in life, but very few people are actually willing to put some time and effort into their financial wellness. So the fact that you're here says that you're willing to take some action to secure your financial future. So it's an honor for me to try to help you to do that. And today's the 3rd session in our series of financial wellness webinars, which I hope will provide you with a comprehensive education and some actual practical advice to improve your financial wellness. My mission in the program is to help you to develop a plan to achieve financial freedom at some point in your life. We define this as accumulating enough wealth to produce an income stream that you'll never outlive. And the pursuit of this program is to help you to set a goal and then create a plan to achieve that kind of financial freedom in your own life someday. I know that probably may seem impossible, but anything's possible with a little education and a lot of your own commitment. So just to recap, in January, we kicked off this program by presenting a summary of our philosophy of investing and the 9 pillars of our investment approach. Then last month, we started building your own personal wealth planning blueprint and outlining your custom written financial plan for achieving future financial freedom. I hope those sessions provide you with a solid foundation of understanding that we can now continue to build on throughout this year. So if you didn't tune in, I would definitely recommend that you watch those video replays. I also strongly recommend that after you watch last month's webinar replay, if you're married, you take what you learned about how to run your own financial planning numbers, download the planning worksheet we worked on, and repeat that exercise with your spouse. Wealth planning is a team sport when it comes to married couples, and unless both spouses are on the same page, your plan has a very low likelihood of success. So as we continue our journey to financial freedom together, today, we're going to build on the calculations you did last month. We're going to start building your own personal wealth policy statement and commit to your custom written financial plan for achieving future financial freedom. We're going to help you to understand how to draft your written financial plan. And so I'd like you to follow along for yourself. So grab a pen and paper so you can take notes, and let's get started. So if you were with us last month and you did the exercise with me, there are a few key pieces of information that you should know by now. First, you should have a realistic idea of when you'd like to retire or begin to slow down your work efforts. Second, you should know how much annual income in future dollars it's going to take to fund your lifestyle. Again, even if you had to run numbers a few times, you should have come up with a realistic goal. And third, based on your future desired income, You should have a calculation of your number, which is the total amount of money you're going to need to accumulate in your investment portfolio by your retirement date in order to fund your income goal. And then fourth, and probably most importantly, a monthly savings number that you're willing to commit to yourself between now and retirement every single month. And then fifth and finally, the target rate of return that you're going to need to achieve in order to meet your goal of turning your monthly savings into a pot of wealth equal to your number. So if you remember, I recommended that you use this technology called calculator.net, where you can run all your calculations for this. You can play around with different scenarios. You can change your retirement date. You can change your retirement income desire, and come up with a plan for savings that you believe you can achieve and the resulting retirement income that you think you can live with. So once you have these numbers, the next most critical thing that you need to do is you need to put them down in writing in your custom wealth policy statement. So remember, one of the key elements of our philosophy on growing your wealth is that people who put their plans in writing have a much higher probability of being successful over time. So I recommend to get it down on paper. In my firm, we use a document we call a wealth policy statement, and I've included a sample version here so that you can review how we document this information for our clients. So you can use our format or create your own. It's your choice, but it's important that you do something, get something in writing. So our document's pretty simple and shows the following things for our clients. First, we begin with whether they have some specific end estate goal in mind, a specific amount of money that they hope to leave behind to their family. But then importantly, we put down on paper your savings requirement. How much money our client is going to pledge to themselves that they're going to save into their portfolio every year. And again, I recommend that you put that number in writing. Then the income requirement, how much retirement income you hope to produce to live on once you're retired, okay? And then your emergency fund requirement, how much emergency cash you plan to keep on hand. And then finally, your targeted investment allocations, which we're going to talk a little bit more about in a minute. Once you've taken the time to create your own written policy statement, then you need to review this statement with your spouse every single quarter until you retire and see how you were able to do on executing on it in the last quarter, particularly the savings goal that you committed to. So I recommend that you use this quarterly process as an opportunity to set and review a household budget that you can live with, and that will hopefully then support the monthly savings goal that you committed to each other. In fact, once you have your budget established and have committed to your monthly savings, my very strong recommendation is that you set up any savings program you have through some sort of automated mechanism, like an automatic payroll deduction into a 401k plan or some other form of savings plan. Take it right off the top of your paycheck. If your savings are automatic, it makes it so much easier to follow your plan. So your written plan should also contain a policy for how you're going to handle your investment allocations, which we call your refill and rebalance strategy, which I want to spend some time on today. This is a strategy that should happen once a year at the same time every year. So to refresh your memory from our first session, there are a few key points that are important to remember about your investing program. The first is that the only real pursuit of investing is to preserve or even grow your purchasing power. So if I have $1 today and I'm going to forego spending it today and save it so that I can spend it sometime in the future, well, the $1 I set aside better buy at least as much stuff in the future as it buys today. So preserving purchasing power is our primary goal. The second point that you should remember is that historically stocks have done a way better job than bonds have in growing purchasing power by really more than double. So if you look at the chart on the screen and you look back in history at the returns of the S&P 500 compared to returns of high quality corporate bonds, the S&P 500 has returned something around the neighborhood of 10% per year, and bonds have produced something around the neighborhood of 5 to 6% per year. So stocks, or what we call equities, have done a much better job of growing your wealth, or at least preserving your purchasing power after inflation, than bonds have. The third point to remember is that even though most people think stocks are risky, They're really not risky, they're just volatile. Historically, there's no such thing as losing money for an equity investor who has a reasonable time horizon and the fortitude to ride out the temporary ups and downs in equity prices. This doesn't mean that stocks aren't volatile, because they are. Historically, stocks pull back by something like 10 to 15% on average every year. They decline. And then once every 5 years or so, they pull back even worse by something more like 30 to 50%. So if you remember our bear market chart that we covered in the first session, you'll remember that there have been about 15 or 20 times in the last 100 years that the stock market has declined by something between 20 and 50%. However, they've always recovered from those pullbacks and then have always moved on to new highs. So since 1945, although there have been 15 bear markets of as much as 20 to 57% in decline, every single one of them recovered and then moved on to a new high. In fact, in 1945, the S&P 500 was at 20. Today, I think it's around 3,900. So on average, no matter how bad these bear markets may be, they always recover, they always move on to higher highs. And typically, the time it may take is something in the neighborhood of 2 to 5 years for a bear market to recover. So in fact, historically speaking, the average bear market in the last 100 years has recovered within 40 months, to be precise. So with that review of the historical facts in mind, you may remember that our firm has developed a very simple but effective strategy for how we recommend to allocate your investment capital between stocks, bonds, and cash, or money market funds. And this is the policy that I recommend you put in writing in your wealth policy statement. So we call this approach time-based allocation, or in simple terms, our bucket strategy. And here's how it works. So first, we look at your entire financial wealth and we divide all of your money into 3 separate buckets allocated by time horizon. We want to know, when are you going to spend the dollars that are in those buckets? So first, we calculate the amount of money above and beyond your normal earned income that you think you might need to pay your expenses that may come up for living in the next year. We call that your short-term bucket. And we place this amount in cash, like an emergency fund, so that we know it's safe and it's not going to fluctuate and it's not going to go anywhere. Next, we calculate the amount of money above and beyond your normal income that you think you might need to take out of your investments in the next 5 years. And that amount goes into high-quality short-term bonds. Similarly, we might get a little bit better return than a money market fund, not much, but we also know that those bonds are going to be relatively stable. They're not going to fluctuate in value. Not going to get much return, but they're not going to fluctuate in value. And then finally, any dollars that we reasonably believe will be set aside for longer-term needs, like college for the kids or retirement, are going to go into equities. Because this bucket of money has a long time horizon of 5 years or longer, and we believe that most market pullbacks will be over and recovered within at least 5 years, we feel comfortable saying, well, this bucket, we can allow it to grow, and we can allow it to ride out those short-term ups and downs of the stock market. So our recommendation, and to write this into your investment policy or your wealth policy statement to yourself, is to set an interval every year, once a year at the same time, to review, reset, and refill these buckets. Take a look and see, make sure that you've got enough money in your emergency short-term cash reserve fund, and that's funded with a money market fund, typically we say with something like 6 to 12 months of living expenses. Then take a look at how much money you think you might need to withdraw from your investments above and beyond your earned income in the next 5 years, and place that in your medium-term bucket, which should go into short-term bonds. And then everything else goes into equities for growth. So for most people on the call probably, if you're still working, this should be a pretty easy process, because once you set up your emergency fund of 6 to 12 months of living expenses, that should just stay there, and unless you need it, unless there actually is an emergency, but it should just stay there. And you shouldn't need it because you're working and earning a living every month. Likewise, your medium bucket may not be that important because you're planning to live from your earned income and you don't need to withdraw from your investments over the next 5 years. So there may not be a need to even fund this part for most people on the call. Most or all of your money can go into your long-term growth bucket. However, once you're getting close to retirement or are in retirement, and now you're within 5 years of retirement or spending from your portfolio and drawing from your money from your investments, the process becomes a little more complicated and may require a little more time to budget the proper amount to be placed in each bucket. Essentially, the way it should work is that each year that passes, you'll spend your annual budgeted amount of cash from your medium-term bucket. So at the end of that particular year, the medium-term bucket won't have 5 years of reserves in it anymore. It'll only have 4 years of reserves in it because you spent 1 year. So the process then would be to go liquidate another year's worth of living expenses out of your long-term bucket, out of your equity investments, to replace the year you spent in the medium bucket. However, and this is the really important part, we only do that refilling process in a year in which the long-term equity bucket actually grew and the stock market went up. If your equities declined, if your long-term bucket declined, and the markets experienced a bear market, we don't refill that year. We don't sell your equities while they're down. We instead just give them another year to recover. We just let that medium bucket kind of sit a little underfunded for a period of time, maybe for another year, because you can catch it up in another year when the equity market begins to recover, which the odds are in favor of that happening. We just don't want to be selling your equities while they're down. So in this way, you're only going to harvest from your growth bucket when it has actually produced a return. And you're never going to be forced to sell your stock holdings while they're down. So finally, and we get a ton of questions about this. So let's talk about how you actually invest that long-term bucket. So what actual stocks or stock funds to own in that long-term bucket? So before we do that, I just want to comment on the concept of outperformance with respect to your investment portfolio. Of all the lies that are told by the financial media and the financial product advertising industry, the biggest one is that you have to spend a ton of time going out and finding that 5-star fund that's going to always outperform the market. I've seen so many investors waste so much time and energy on the obsessive hunt for outperformance, for picking the right fund. And it's nothing but a distraction from the real issues which are going to drive your investing success. It's a waste of time. The goal is not to identify investments which will outperform most other people's investments. The goal is to behave in such a way that you achieve a better long-term, real-life rate of return than most people get. We're not trying to produce the highest possible investment returns because that's an impossible goal anyway, because something somewhere is always going to be doing better than you are. Rather, the goal is to earn the returns you need to fund your financial plan and reach your goals. And there's 2 ways you're going to do that. One is through asset allocation, which means owning as much of your wealth in stocks as you can over time. And 2 is through your own behaviors, which means not panicking out of your stocks when markets get volatile and scary. So the buckets approach that we just talked about is going to do 90% of the work on both of those efforts. However, since so many people spend so much time wondering about what portfolio investments to actually own, so let's talk about the concepts that you should use when you're building your investment strategy in your long-term equity bucket of money. So in our opinion, there really are 2 things that matter here. The first is diversification. Asset allocation is investing concept number 1, and that governs how much of your money you put in cash, bonds, and stocks. That's the buckets. Diversification is a close second in importance, and that speaks to how you blend your investments within your stock portfolio. So although you can slice and dice the stock market into a whole bunch of different categories, in our view, it's really sufficient to consider 7 major categories of equity investment that you can choose from. American large cap growth companies, which are companies that are known for growing their earnings. Just give me 1 sec. Let me advance this manual. There we go. Large cap American value companies, which are companies that are known for selling for an undervalued stock price. Small American growth companies, small cap companies. Small American value companies, international companies, emerging market international companies, and then real estate and real assets. So 7 categories. And equity diversification is based on the idea that we have no idea which of these different sectors of the market are going to be hot next, or which one is going to fade for a season or two. So we want to own them all in roughly equal measure. Because they're all equities, we'll ultimately get the long-term equity returns we want. But because they all run on different cycles against one another, some will be shooting out the lights while others lay dormant, and then they'll switch places. And so in that way, by owning them all, we'll be able to blunt some of the volatility of any one given sector. Basically, the rule is I never want to own enough of any one thing where I make a killing, but I also never own enough of anything where I'll be able to get killed by it either. So basically, this rule protects us from our deepest, most human desire to chase performance and to bet the ranch on one investment style just because it's been hot lately. So we're owning some investments that aren't doing that great right now on purpose, because soon enough, they're going to turn around and become our best performers. We're deliberately attempting to create some tension in the portfolio by owning sets of investments that tend to run on different cycles. So that way, we always know that we didn't chase the thing that's that has performed the best, but is about to hit the dumps. And then the second thing that really matters within your equity portfolio is rebalancing. And rebalancing means the disciplined practice of rebalancing your investments back to those desired weightings annually on the same date. So, for example, if you start the year owning 7 funds in all of these different categories in roughly equal weighting, by the end of the year, those weightings are going to be all out of whack, because some of the areas are going to do a lot better and some are going to do much worse. And so you'll no longer have an equally balanced portfolio. So by rebalancing them back to your original weighting, you will be withdrawing capital from the most popular, highest priced funds in your portfolio and redeploying it into the out of favor, lower priced, but higher potential sectors of the portfolio. So somewhere I remember someone saying that it's good to sell high and buy low. And that's what you're doing here. You're selling the investments that went up the most while they're high so that you can buy more of the cheaper ones, which are currently low. Of course, most investors do the exact opposite. They get tired of the laggards in their portfolio, and so they sell all those investments that aren't doing well so they can load up on the ones that have been doing better lately. This is why most investors don't achieve investing success, because they're buying things that have already played out. So on a final note about rebalancing, discipline is really important here. This should be done once a year on the same day every year. If it isn't done on the same day every year, now you're adding in the human element. You're picking a day to rebalance based on your opinion of market conditions. Hey, looks like stocks are up today. Maybe I should try to do my rebalancing today. Just do it with discipline at the same time every year. Really, otherwise all you're doing is engaging in market timing. So I hope that was helpful in terms of how to structure your portfolio. And now I'm going to answer some of the questions that came in advance, and then maybe we'll have some time for questions that are coming in during the webinar. So let me get my glasses on here.
We did have a few questions come in, Eric. One of the first ones is, how much would you recommend allocating to an emergency oh-no fund for unbudgeted or unexpected expenses?
So that's a really good question. I mean, typically a rule of thumb that we use, and then I would say, is fairly accepted principle is 6 to 12 months worth of living expenses. I generally say that that can vary. It's an individual decision. A lot of it depends, in my view, on how much income you're earning now and how stable you feel your job is, right? So if I'm a very high income earner and I'm really confident in the industry I'm in, we're doing really well, I'm making a really good salary, and my company's in great shape and my job's solid, then you certainly can go to the lower end of that. scale, that emergency fund scale, maybe down to 3 months. If I'm a little worried about my job and maybe I have, parents who are unhealthy, and that could become an emergency where they might need some help, or another family member might need help. If I have other financial risks in my life, then probably that emergency fund wants to tick a little bit higher. So it is an individual decision, but typically we say something like 6 to 12 months.
Okay. Another question we received is more related to income and retirement. Crystal wants to know, how can she plan for retirement? And she also mentions Social Security.
So, I would, first thing I would really recommend for you to do is to go back and watch my February webinar, because that was really a deep dive in how to start running some numbers. Go on that calculator.net site that I showed you a minute ago and start playing with, some numbers to try to figure out how much you're going to need to save and what kind of investment return you're going to need to achieve in order to hit a retirement income goal that you think is reasonable. And, that may take several iterations. I mean, it's not, we don't all have a magic wand and be able to just build like a multi-million-dollar investment portfolio overnight. It may require some trade-offs in terms of what your retirement goals may be, what kind of retirement income you want to be able to live on. But at least it will arm you with the knowledge that you need to be able to start running the numbers and start getting an idea of where you stand. It's one of those things really where I would just say this as a general statement. When the skeleton's in the closet, it's like real scary, like, because it's out of sight and it's just. But at least it may still be a skeleton. But when you pull it out of the closet, the devil is not quite as scary. So when you start at least running the numbers and at least start getting a gauge and an understanding of where you stand, it can be really empowering, because then at least you can start making some decisions about, okay, well, I wanted to retire at 65. That's not going to be possible. I'm going to have to work till 68 or 70. I wanted to live on, whatever, 50 grand a year in retirement income. That's not going to be possible. I gotta reduce my goal. But I still can hit, a age 70 retirement on 45 grand a year. Okay, I'm willing to deal with that. That's a plan that I can live with. So I would really definitely recommend to run the numbers. And also in that session, we also did touch on Social Security. I would tell you that there's SSA.gov is a wealth of knowledge and information about how Social Security works. You can do your own personal calculation, plug in your information, and it'll actually give you an estimate of what your income will be in Social Security, depending on when you decide to choose to take it. So it's really, really helpful resource based on your own personal work history. As a general rule, we typically, so you'll have the one decision you have to make with Social Security is when you choose to start taking it. And you can start taking it typically as early as 62, and you can postpone taking it as late as 70. The longer you wait, the higher your benefit will be when you finally do start taking it. We usually recommend for people that are healthy and feel like they have kind of a longer life expectancy to wait. In fact, usually for most people, if you wait till age 70, you have to live till about your early mid 80s in order to make it worth it to wait, but then get that higher payment every year. So part of it does depend on your health, your family history, or whatever, and how long, what you kind of longevity you think you may have. But the longer you think you may live, probably the better it would be to postpone taking Social Security. But anyway, that SSA.gov will give you everything you need to know about your Social Security benefits. So when you're running the numbers that I recommended for you to run, you can plug in a real number for your personal Social Security projection.
We got several questions, Eric, related to 401ks. How would you recommend investing in a company matched 401k?
Well, first of all, just to kind of define terms on that question, your investment strategy in your 401k really isn't necessarily dependent on whether the company there's a company match in play. Your investment strategy in your 401k should really follow everything I just said, in my opinion. So, number one, regardless of how the money got in there's money in your 401k plan. How do you want to invest it? Number one, use a buckets approach. I will say, for most people on this call, unless you're within 5 years of retirement, my personal view is your 401k money should be in equities. Now, your own situation you may be planning to borrow from it. If you're in a financially difficult situation, you might have to, withdraw early from your 401k. So those are considerations. But for most people on this call, most likely your goal is to have that money in your 401k plan for a long time. I mean, you can't take money out of your 401k plan without a penalty till age 59 and a half anyway. So if you're more than 5 years out from, if you're 55 or I'm sorry, 55 or younger, my view is, your 401k plan should have almost all equities, because over time, that's going to give you the best return. And what we just talked about with respect to 5-year bear markets, well, if there's a bear market and you have at least 5 years to ride it out, my view is most likely, I'm not guaranteeing this, but most likely within 5 years, the market will be back on track and hitting higher highs. So your investment strategy for the dollars you have in your 401k, in my opinion, should follow the buckets approach I just described. And if it's longer than 5-year money, it should be almost all equities, and look at those 7 sectors I just described with the rebalancing as I just went through. If your question is more with respect to, should I take advantage of the company match? So basically, on that topic, what I would say is, first of all, yes, there are a couple different layers of the benefit of a 401k contribution. So definitely the first dollars that you put in, if your company has a match, you get a break from Uncle Sam. So dollars that are going into the 401k plan are pre-tax contribution. They're not only federal income tax free, or a pre-tax deduction, but they also are exempt from payroll taxes too. So like $1 of pay, $1 goes into your 401k. No taxing authority gets their hands on it. Okay. And you may get a match from your employer up to a certain level. Okay. So definitely up to that employer match, like if there's anything you can do to get at least that much money in every year, absolutely. So if your question is, should I stop funding my 401k plan above the employer match? My answer would generally be no. If you've got the discretionary money to fund it all the way up to your actual max, then definitely do that, because you're still getting that tax advantage. Now, of course, if you need that money for other sources or whatever, then you have to do what you have to do. But if you can figure out a way to fully max out your 401k contribution, I mean, we always advise that's the first place that you should save. The first dollars that you have available for savings, don't move on to any other buckets of savings until you've fully funded your annual 401k contribution.
We did just get a question about if the first 2 videos in this series are available if you missed them. And the answer is yes, they are available on the Wellworks portal, and you will be receiving the recording of this webinar as well.
Yeah, I would, this curriculum is intended to kind of build on itself through the year. And those first 2, in terms of setting the framework for your financial plan, really are critical, especially one we did last month, because I walked you through piece by piece, like here's exactly how you can run your own personal numbers for a retirement plan.
Eric, someone's asking a question about working with financial advisors and the kinds of fees you can expect, or what you should look for in terms of fees with working with an advisor. Do you have any insight into that?
Yeah, I mean, I would generally say that it's still true that most of the financial advice business is structures fees based on the assets that you have and how much money they're investing on your behalf. So that I would say that's most advisors. And typically, depending on, it's the kind of thing where certainly the more money you have, typically the lower your fees go. I've seen some metrics, some industry metrics that indicate that I think the average investor across like the whole industry is paying something like 1% to 1.25% for qualified financial advice. Certainly, there are clients who are going to get a better deal than that. I mean, I would say that I'm not sure it would be uncommon to say that anything down to even maybe 70 basis points, so 0.7% of your assets that an advisor might charge. And I mean, I've seen as much as 1.5% or even more being charged. One thing I would say, I can't say I'm super proud of our industry in terms of the transparency with which we handle fees, and particularly, you always have to think about what are the fees you're paying for advice, but then what are the fees in the products that you're using too. So I'm a financial advisor, wealth manager, so we charge our clients a fee for our services, the advice. But then the investments that we recommend for them to use may also have fees associated with them. The insurance policy we recommended, the annuity that they went out and bought, whatever. So those products may have fees as well. One thing I believe strongly is that those two sets of things should be separated, and that you should always know what are the fees I'm paying for advice and what are the related product fees. And in my view of the world, me as the advisor, I shouldn't be getting a piece of those product fees, right? So there are environments where financial advisors are there to sell you a product, and then the product has fees in it, and then the advisor is getting some sort of trailer or commission or whatever from the product that you bought. Obviously, there are a lot of advisors out there who would argue that, for many reasons, that's okay and that's better. My personal view is that we prefer to work with clients in a way where we're going to charge you a fee for advice, and you always know that the fees we're charging and the income we're earning is based on the advice and the services that we're providing you. And then we're going to recommend products to you that will also have charges, but they're totally arm's length. So you always know that the only reason I'm recommending those products is because I think they're the best. Okay, I think they're the best for you, and not because there's some sort of payment coming back to me. Because sometimes those payments, those commissions or trailers or whatever, may be not totally transparent to the end client. So my personal view is, if I were a client, if I were looking for a financial advisor, I'd find someone who's what's known as a registered investment advisor, which is what our firm is, and it's a fiduciary, what they call a fiduciary approach, which basically just means my mandate is to act in your best interest. You're paying me a fee to act in your best interest, to help you pick from the world of products and services that are out there, and I'm not getting paid from that world. So that way you always know that my advice is objective and it's a transparent setup. Hope that helps.
Here's a question, Eric, that is probably top of mind for a lot of people. How does the bucket approach apply to saving for my children to go to college?
Pretty simple. I mean, you can look at your you can look at your college expenditures kind of separately from your retirement, or in a lot of our clients' cases, we'll do a comprehensive cash flow plan and say, college expenses count. When we're doing the calculations for your bucket every year, we're factoring in everything that you plan to take out of your bucket. So, so for example, though, if you had money specifically set aside for your kids for college, I mean, the way I would recommend to handle it is if they are not going to be going to college for at least 5 years, then their college fund should be all in equities. Once they get within 5 years, you should pick off a year at a time and fund it into something, less volatile, like, bonds or something, or cash, so that way, up until they're, 13 or whatever, 13 or 14, you're really trying to maximize growth and you're investing in equities. But once you're getting within, 4 or 5 years of that first year of college, you're taking, a quarter of what your college savings were and putting it into something that won't be volatile and that'll be safe. So just apply that same buckets, construct to money that's specifically set aside for, the rule, again, the rule is any money I plan to spend in the next 5 years coming out of my portfolio, I want in something that isn't going to fluctuate, but if it's money that I plan to spend for, 5 years or longer out, I want it in equities. So that's the bottom line.
When it comes to building your river of wealth, is there an age at which it's too late?
Well, again, everybody's situation is different. And I'm not going to sit here and tell you that there's a magic wand. In fact, one of the things that we counsel clients is let's be adults, let's be grownups about the fact that there isn't a magic wand. And if your financial situation isn't where you want it to be and isn't going to, you feel like it's too late or you feel like there's nothing you can do, you can always take your financial situation from where it is now to a place that's a little bit better. Okay. Now you may not take it to where you want it to be, like all the way. And that's a, something that we have to be adults about, but you can always, I don't care what age you are, you can improve your financial wellness. You can do something, I can remember times in my life when I, was young and wasn't making any money, but I would get excited because I, saved like a couple bucks a month. I would forego my Starbucks every day so that at the end of the month I could put, $50 into a savings account or something like that. And, I look back now at, I'm personally now paying for kids in college and some of the things I'm trying to deal with in my financial life. I was like, oh my God, to think back that was a big deal for me back then, but it was better than not having anything in my savings account, right? So like anything you can do, any budgeting, any ability to forego, I don't know, a few of the small pleasures that you pay for in a month. If you can figure out a way, maybe this month I'm just not gonna go out to dinner as many times or whatever it may be, and at least build something so that your situation is just better than it was before. It's never too late to do that. Never. Again, you may not, retire early on millions of dollars of income, but you can certainly make your situation better.
Back to the college question a little bit. What is your opinion of 529s for college savings?
I think they're great. They're pros and cons. So on the pro side, it's a really flexible tax advantage kitty of money that you can use to fund higher education. So the benefit is in a lot of states, actually for money that you put into a 529 and the year you put it in, it's actually a state tax deduction in a lot of states. Not every state, but for a lot of states, that's actually could be a pretty good benefit. So you get something of a tax deduction possibly for putting money into one. And then once the money's in a 529, it's basically tax-free forever. You don't pay any tax on the growth, no capital gains or income taxes on the money as it grows. And then provided it is used for higher education. Okay, so that doesn't necessarily just mean college. It could be grad school, and it actually could even be trade school or adult education. As long as it's used for that, you never pay tax on that growth at all. Now, if it's not used for that, if you withdraw it for some other reason, then yes, you do have to pay actually the taxes that you missed out on plus a penalty tax. So So one drawback is you definitely want to make sure that it's money that you plan to use for education someday. And the other thing that's important to know, and it's a great benefit of 529s that not a lot of people really understand, is that it's transferable to not just within your own family, but to anybody you want. So like, you could have a situation. I mean, we've had clients who are, higher net worth or whatever, but they've had money in 529 plans. And then the time comes to pay for kids' education, and maybe the kid number one gets a scholarship or something. Well, you can take that 529 money from kid number one and transition it downstream to kid number two. You're allowed to actually change the beneficiaries on your 529. And then if all of a sudden you're out of kids and there's still money left in your 529, you could benefit a niece or nephew, a grandchild. You can actually let it run out and ride out until your grandkids are going to school. Or again, as I said a minute ago, it could be used for your kids if they were going to go move on to grad school, or as I said, trade school, or some kind of adult education. So it's pretty broad in its uses. Actually, and now for those who may even have kids in private high school, in a lot of cases, you can actually even use the money for private high school too. So it's got great uses. The only downside is definitely number one, if you put money into it, remember, if you need that money, for some other reason, maybe before college, and you have to draw it out, you're going to get whacked with a penalty tax. So you just want to make sure that the money you're putting into it, you feel pretty confident actually is going to be used for higher education someday.
Does that money have to directly go towards the cost of the institution of higher education, or could it apply to living expenses or meal plans?
It can. There are some, I don't know all the detailed rules on the top of my head, but it can be used for meal plans and for housing costs. There are a lot of not sure about travel, but yes, a lot of the ancillary costs of educating a child, you can use it to offset as well.
We've gotten a few questions about IRAs, Roth IRAs in particular, particularly in comparison to 401ks, and then some confusion around, should they be funding their 401k versus their IRA versus putting their money in equities? You talked about the 401k piece, but any insight into IRAs?
So my general statement on that would be, again, thinking about the buckets, bucket your savings too. So like priority one really should be, if you're just getting started or whatever, you should make sure that any savings money, well, let me take a step back. Priority one, because I saw there were some questions about credit cards. Okay. I've said this several times in these webinars, and I'm going to say it several more times. Number one priority is get yourself out of credit card debt. Don't be saving into anything until your credit cards are paid off. So if you have discretionary income every month that you can put somewhere, and you're carrying a credit card bill month to month, pay off the credit card, because you're paying something like probably high teens interest on that credit card. You're not going to consistently earn high teens returns on your investments. So but number one use of money is get the credit cards paid off. Now that doesn't mean you can't use credit cards every month, and just make sure they're paid off every month. Once that's done, focus on the emergency fund. So even before you fund your 401k plan, I generally recommend, let's get some form of an emergency fund in place. Okay. Now, like I said a minute ago, does it need to be 6 months? No, maybe for you it's a month or two, but get a base of some liquid cash in the event of an emergency. Then once that's done, I would really say 401k is next on the list, because and maxing out your 401k because of all the benefits that you can't match anywhere else. Employer match, federal tax exempt, and also payroll tax exempt. So the difference there is when you're funding $1 into 401k plan, like your Social Security and your payroll taxes don't get hit on that dollar. If you fund an IRA, they do. So even if you're funding a deductible IRA contribution, you may be getting a tax deduction for your IRA contribution. But even if you're getting a tax deduction, you're just getting a federal tax deduction. You're not able, that money still was taxed by payroll taxes. Okay. So the 401k plan is the granddaddy, right? So you get the most benefit out of the money that's funding into your 401k plan. Once you've funded your 401k, then, if you have more discretionary savings, then maybe an IRA contribution, a Roth contribution. If you're eligible, there's eligibility rules based on your income. You may or may not be able to do that. But if you can, then yeah, that's fine. Maybe investing in, general savings makes some sense. I'm generally referring to people that have kind of a longer term time horizons. Like, of course, as I was saying a minute ago, like the emergency fund has to get funded first. If you need a medium term bucket, because you've got your daughter's getting married, in 2 years or whatever, well, you got to fund that medium term bucket. You got to get those near term expenses covered first. But once you've done that and you're thinking towards the long term, 401k first, then IRAs are good. Roth, we've talked on the past webinars about the difference between a Roth 401k and a regular 401k. Just a very brief review of that. If you have both available, it really has to do with what you think your future tax rate will be. If you think that you're going to be in a higher tax rate in the future than you're in today, which could be possible, because if you really think that, look at what we just printed $2 trillion worth of new money here and debt, and you say, well, someone's going to have to pay for that someday, and tax rates are going to go way up. Then probably the Roth is a better way to go. If you think you're going to be in a lower tax rate in the future because, hey, I'm retiring, I'm not going to be earning income anymore, then the regular 401k is better. So that's, kind of a personal preference based on what you think about your tax rates in the future. But both are, valid ways to save. I saw there was a question about, should I consolidate old 401ks into my new 401k, or should I roll to an IRA? Number one, I'm not a big fan of keeping money in an old 401k plan after you've left that employer, because it tends to be out of sight, out of mind, and people tend to not manage those dollars. They lose the website or whatever because they don't work there anymore. I tend to find that. So I'd rather see you either roll, unless there was some features to your old 401k plan that made it, really advantageous. But as a general rule, I'd rather see you roll your old 401k plan either into your new 401k or into an IRA. The main reason to roll it into your new 401k plan generally would be if it has loan provisions. So if you say, well, I want to put it into my new 401k plan because there's a chance I might want to take a loan from my 401k, you can't take a loan from an IRA, but you can take a loan from a 401k. And let's say your new employer does have like a loan provisions in the 401k plan. So you may want to roll it into that just to take advantage of, the possibility that you may want to take a loan at some point.
Eric, we only have about 5 minutes left, and I know you have some questions that you might want to get to. So why don't we touch on one or two of those? And please feel free to continue submitting questions, and we'll try to answer those if we have time left.
Yeah, interestingly, I think you may have had some of the ones that were on my list here, but one second here. Terms of security, medical expenses.
Here's a question we just got. That's pretty interesting. Where's the best place, or where do you recommend keeping the 6 months emergency fund? A money management account, a savings account? Where should people keep that short-term savings? I mean, usually,
I think just in your bank or bank savings account, checking account, even anywhere that's accessible, right? Easily accessed, I think is fine. Not necessarily a huge fan of using like CDs or treasury bonds or anything like that for that, because you really want it to be accessible and not something where you had to pay a penalty if you had to get it. And right now, you're not really getting much return out of that kind of stuff anyway. Money market fund's good. There was one question here about 401k taxes and how to pay effectively. Well, I mean, really, you got to pay them. So remember, with all this talk about, and it touches on this Roth to 401k thing we were just talking about a minute ago. Remember, any money that you're putting into a 401k, IRA, Roth is different, but IRA or 401k, you're getting this great benefit of a tax deductible upfront, and it grows tax deferred. But when you draw that money, that goes on your tax return as ordinary income. So the way that works is when you retire and you start taking money out of your retirement plans, which is supposed to happen after age 59 and a half, at age 72, you have to start taking money out of those plans. You actually have to, there's a calculation for a little bit every year you have to be taking out of those retirement plans. But when that money comes out, when you take the money out of those retirement plans, it's ordinary taxable income. So it goes on your tax return as if it was regular earned income and will therefore go into your tax rate. So when you're doing your calculations about that we were covering last month about retirement income, you definitely want to plan for those taxes. And I would say like it's a little more advanced planning, but when we have clients who have high net worth and they've got various sources of wealth, we may look and see what years might their other taxable income be down, and it's advantageous to take money out of their 401k plan. So there's a lot of planning that could be done around, or if you think that maybe you think that there's another year here where we're still going to be living under the 2017 tax code before the president is able to get a new tax code into place next year. Maybe this year could be a year to really kind of maybe even accelerate, if you're retired, accelerate some of your withdrawals and take a little more taxable income because maybe you think the rates are a little lower than they're going to be next year. So there's definitely some advanced planning around that. And then the last one I just hit on real quick because I just get a kick out of it. And there were a couple of questions about cryptocurrency and gold. I very firmly believe that we are headed into an inflationary environment. So I think everybody on the call should be prepared for that. And, as I said, you don't run up these massive deficits and keep interest rates like ridiculously low like we are and put, $1,400 checks in people's pockets and not have inflation start to happen. That's just, in my view, something that now, we're going to have hyperinflation. We're going to have, return to what it was like in the 1970s. Time will tell. I think for a variety of reasons, probably not. But I do believe that we will begin to see a pickup in inflation. In my personal opinion, historically stocks have done really well. It's one of the reasons why I think stocks are doing well now is because we are having this kind of inflationary tailwind. International stocks, if the dollar starts to really decline and inflation really gets going, international stocks tend to do well. And I'm a bigger fan. If inflation really got kicking, I'm personally would be a bigger fan of things like real estate and commodities that are usable, like oil, industrial metals, things that actually contribute to productivity. Gold doesn't do that, and cryptocurrencies don't do that either. All they really are is an alternative currency that, in theory, is and I do say in theory because I'm not totally convinced that this is true, but it's limited in supply. So because it's limited in supply, it can't be inflated. Specifically with respect to gold, I prefer to own a basket of real estate and timber and industrial metals to gold, because those things are used in the economy. Like those are actually productive commodities. But cryptocurrencies, for me, I wouldn't touch them with a 10-foot pole. You got 3 red flags. You got volatility, you've got impossible to value, and you've got total unregulation, right? And particularly that unregulation part, I believe that one of the reasons that that Bitcoin or whatever is going up like it has is because there's this sense that if all of a sudden things really start breaking down and there's hyperinflation and you want to get your money like out of the country or whatever, which is one of the reasons people own gold. Like it's kind of the societal breakdown hedge. Well, with cryptocurrency, all you need is a password, and you can be in Switzerland or whatever, and you can access your crypto, and it's kind of goes under the radar of governmental regulation. That may be true now, but I don't necessarily believe that's going to be true for long. And so if it's not, I believe that, there's probably a fair amount of Bitcoin, excitement that maybe goes out the window. So I personally wouldn't own it. Maybe I'm crazy and maybe it goes to the moon, but I personally would not recommend that you own, Bitcoin. Blockchain technology, all for it. It's, the technology behind it is, I think, is going to revolutionize the world in a lot of ways. But the actual, cryptocurrencies, I'm personally I'm not in. So anyway, so before we close, I'll just let you know about how this program is going to continue. So today was the third in our monthly series. It's going to last all year. On the third Wednesday of every month, 2 p.m. Eastern time, we're going to host these educational webinars. And as I said in the beginning, our mission is to help you to create your own written plan to achieve some kind of financial freedom someday. So we're going to walk you through a step-by-step process for how you can do that for yourself, and also provide you with advice on how to deal with the primary risks, which we're going to start moving into now, to your long-term success. Things like premature death, disability, taking on too much debt, Uncle Sam taking all your money in taxes. So these sessions are free. They're provided by your employer, courtesy of Wellworks. And all you need to do is tune in and watch every month. And I promise by the end of the year, you'll have the knowledge you need to follow your own financial freedom plan. So I'll see you next month on April 21st at 2 p.m. And I hope this was helpful.